If you want to go for a home loan, you need to understand 4 important points that impact how much you can borrow. But before we talk about those points, let's talk about what your actual borrowing capacity is. Your borrowing power is the amount of money you can lend from the bank. The more money you can borrow, the higher the purchase price of the property you can purchase. So what impacts your borrowing capacity? First of all, your income. Your income is determined by not just how much you earn, but how long you've been in your job and whether you're full-time, part-time, or casual. Another thing that impacts your borrowing capacity is your current financial commitments. Even a HECS debt can have a big impact on how much you can borrow. Think about credit cards, personal loans, and even buy now, pay later. When you go into a store and you buy something on a hire purchase or on terms, these sorts of things can impact your credit rating, and they can also impact how much the bank will lend you. Government grants or schemes can also impact your borrowing capacity as well, because they can impact whether you pay lender's mortgage insurance or not, and they can also impact whether you get an additional sum of money from the government that you may be able to put forward as a deposit. Fourth, interest rates. Interest rates have a big bearing on how much you can borrow. So every time there's a rate increase, your borrowing capacity drops. And if interest rates drop, then your borrowing capacity goes up. Are you ready to find out what your borrowing capacity is? Then click the link at the bottom of the video.